Alright, we've started our YouTube live as well as our TikTok live. We will be recording this, so if you are watching the recorded version, if you're not watching live, I would highly suggest just watching the recorded version because there will be timestamps available for you to look at. So you can kind of pick and choose what you are viewing. So I am going to wait a few moments just so there are some people in the live chat so they can watch it live, and then we'll get started here. I think actually it just makes sense to kind of start right here because there are actually a few people coming in. Alright, so let's just put this over here. We'll be talking about the 1970s, what happened, what caused it, looking at the debt crisis during that time, and then trying to speculate to see, are we going to be entering something similar, looking at how safe havens reacted like gold during that debt crisis situation. So we'll talk about that very shortly. All right, just make sure that we are recording the right stuff, and then we'll get our recorder and let's get started here. Hey traders, welcome to a global macro update. In this video, we'll be going over the 1970s debt crisis and looking how other safe havens acted and reacted during that time. Mainly just looking at gold, but looking at from 1970s all the way for an entire decade to 1980, what happened, and then we'll discuss post-1980 onwards to the current day. So first off, let's just read this article here. The debt incurred over time from coronavirus stimulus spending could mean a deeper crisis and default risks for some countries, according to recent economic reports. The current wave of debt accumulation, which started in 2010 and the 2008 financial crisis, is the largest and fastest, most broad-based increase in global borrowing since the 1970s. And we can see the debt crises may be coming, the Economist Intelligence Unit wrote in late March. For now, governments are ramping up fiscal spending to fight the epidemic, maintain basic economic architecture, and keep workers in their jobs. As a result, fiscal deficits will rise sharply in the coming years. So now actually let's look at the 1970s. What happened? What caused the debt? What happened to precious metals? Mainly just talking about gold. Looking at the chart that dates back a while. I'm going to get a little bit of coffee and then we'll continue on with the video. All right. How the great inflation of the 1970s happened. In the 1970s, the stock market is a mess. It lost 50% in a 20-month period, and for close to a decade, few people want anything to do with stocks. We'll look at that in the later part of the video. Economic growth is weak, which results in rising unemployment that eventually reaches double digits. The easy money policies of the American Central Bank, which were designed to generate full employment by the early 1970s, also caused high inflation. So then, there's going to be media pointing fingers, and we see that in the 1970s, the Great Inflation was blamed on oil prices, currency speculators, greedy businessmen, and union leaders. However, it is clear that monetary policies, which financed massive budget deficits and were supported by political leaders, were the cause. It's not the free markets. It is these monetary policymakers that meddle with free markets that don't make it free markets. They fix supply of goods and services. They just inject basically newly printed money into the system, which in the long run obviously is unsustainable. How and why? So why did they actually even create money in the first place? Two reasons: to fund a war and for social welfare spending. Mainly it was the Vietnam War and the Great Society, which was their social welfare program that they had in the 1970s, or 1969 here. And why did they spend so much? Why did you think that it was a good thing? John Maynard Keynes was an influential British economist in the 1930s and 40s. So they, to this day, are actually Keynesian economists. This is their way of thinking. Governments should use counter-cyclical policies in hard times, running deficits in recessions and depressions. Even now, they're even going to a more aggressive approach of modern monetary theory, which is basically you can just buy your own debt and print really unlimited amounts of currency, because we've seen Japan do it for decades and there's no real major repercussions that they're having. So, we can run this thing hot for decades and decades and it seems to work, is what they're thinking. So, Nixon's deficits were also making dollar holders abroad nervous. There was a run on the dollar, which many foreigners and Americans thought was overvalued. So, a decrease in the value of the dollar, you're going to see confidence in the US dollar diminish, and then investors around the globe are going to go into safe haven assets like the gold, precious metals sector. Now introducing cryptocurrencies is a very interesting ballgame. This is something that we've seen before recently. Nixon wanted cheap money, low interest rates that would promote growth in the short term and make the economy seem stronger as voters were casting ballots. I think this is going to happen very shortly, where, this upcoming election will be basically who can provide the most free money for people, and this will cause, in my opinion, significant inflation. So we can see these are like not much of an actual increase compared to what we're seeing now. M1, which is a total checking deposit, demand deposits, and travelers checks, went from 228 billion to 249 billion between 1971 and 1972. The amount of M2 numbers measuring retail savings and small deposits rose even more by the end of 1972, from 710 billion to 802. It worked in the short term. Nixon carried 49 out of 50 states in the election. Democrats easily held Congress. Inflation was in the low single digits, but there was a price to pay in higher inflation after all the election year campaign was guzzled. It's not instant. It takes time for it to get into the system to start to see those price increases on your everyday goods and services, especially if you're giving it to everyday individuals. Unlike in 2008 when they had the bailouts, they bailed out the banks, they gave the money to huge corporations, and that didn't really affect the prices of everyday food services. It affected major assets, traditional assets like the stock market and then real estate. You saw huge inflation in those asset classes. But now you're giving freshly printed money to everyday individuals who are going to be buying goods and services, and then you will start to see the inflation in time because it's going to Main Street as well as Wall Street. So, bottom line, it would take another Fed chairman and brutal policy of tight money, including the acceptance of a recession, before inflation would return to low single digits. Major thing is accepting of a recession. Do you see any sign of accepting a recession right now? Definitely not. They're trying to fight it tooth and nail. They're saying that it's going to be an L recovery, or there's some level of a recovery, and I just don't see it. And we'll look over the chart of the 1970s very shortly. But in the meantime, the US would endure jobless numbers that exceeded 10%. Millions of Americans were angry by the late 1970s and late 1980s. So now, let's look at how gold reacted during that time. So we see during the 1970s, it was around $35-ish before 1970s. It got a little bit of a bump to maybe $45, but it was kind of bound in a range for many years, around $35 to $40. During the start of the 1970s, going in 1971, 72, 73, it did gain some traction here, and then by the time it was around 1975, it was around $185-ish. So it jumped significantly from 1970 in a few short years. Now, we did get a little bit of a lull here, dropping from $186 all the way to around $100, which is around a 45% drop. But what happened after was a monumental bull run that from 1977 all the way until 1980 rose, let's just see here, over 750%. But if you were buying around the $35 ranges before the true worry of inflation occurred, you'd be looking at over 2,000% gains here, from $35 up to, obviously you're not going to sell right at the peak, but in terms of price appreciation potential, that's just unbelievable. So we can see that if there is a worry of inflation through the 1970s, safe haven assets like gold do provide a not only stability in your wealth, but huge exponential increases here. And with crypto involved within the current potential monetary policy that we're going to be implementing with the full reset, we have no idea how much blockchain will be implemented with really the kind of the new world order that we're going to be living with. because during the 1970s we got off the gold standard, where we got off the Bretton Woods system, and fiat currency was introduced. We didn't have any backing with gold before that was cut. We did have to have some level of backing, but in 1971, I believe, or two, when the Bretton Woods was cut and fiat currency was introduced, you didn't have to have any backing. It was just a confidence game for fiat currencies, and that's why you saw huge inflation. And right now, it's just a confidence game right now too. Look at how much money printing is occurring within the United States. It's unbelievable. Just going to finish it off with the stock market here during the 1970s to the 1980s. This right here is January 1970, and then we see the 1980s right here. We just see some chop all around. We're seeing lower highs. We saw a massive sell-off. That was that 50% sell-off that we read about, 45, kind of from main candle closure to candle closure. And then we saw a massive rally with a huge double bottom. And we did talk about the 1930s, and we saw that huge decline in the stock market, but we could get stagflation, where we're just seeing consolidation sideways. We don't exactly know until we start to see this all play out, but it's really, really helpful, in my opinion, to look at previous historic times where we've seen huge money printing, or we've seen a massive bubble, like the 1929 huge sell-off, and then we saw a massive bounce. Looking at previous historic price action, looking at situations where we've seen massive inflation or potential for massive inflation occur before is a great way, in my opinion, to try to understand what could possibly come into fruition in the future. So thank you very much for watching. That is the completion of the global macro update. We really hope you liked it. If you found this useful, entertaining, please subscribe to our channel. It would help out greatly. And if you would like a community, a Discord that shares this kind of information absolutely for free. We talk about it all the time. Definitely check the link below within the comments. We do have a link down there for our Discord. So thank you very much for watching, and until next time, have a good one. All right. Now we're going to go into all the questions. It was actually a pretty quick one today. It was 12 minutes. I'm trying to cut it down a little bit to make it more digestible, because if I talk about the price action a lot, I feel like I lose people in some sense. So trying to make him a little bit shorter, and then in these lives I'll actually break it down, because the view time of the videos that I do that are on average, let's say 50 minutes to an hour long, probably get like 10% watched. So that's obviously a very low percentage of the video watch, so it just makes sense to kind of shorten them and like try to grab more attention in a shorter amount of time, because if you're sitting there and you see it's an hour long, you're going to kind of be like, okay, well, I'm not going to sit here for the entire time. But if it's 10 minutes, a lot of people can bear that, I think. But we will see. All right, now let's actually look at gold here, not this chart. We're looking at AXU paired with USD. Now that we've seen the 1970s, obviously that was a huge move. But what occurred after is a 20-year consolidation, basically. From the peak from the 1980s, it consolidated. It kind of looks like Bitcoin's consolidation. If you draw it like this, where if this is the breakout point and then this is the total capitulation, this was the volume accumulation that BTC had above the $3,200 zone, and then obviously we're seeing a lot more volatility with Bitcoin, but you can kind of argue that it looks like somewhat of that triangle there. But after this 20-year consolidation, from the 2000s, when it kind of turned into the 2000s and onwards, it saw a massive price move to the upside here, breaking the all-time high of around 870 and then forming the new high of 1900. So huge move we had on gold after the 20-year consolidation. And then we saw another consolidation here where it held a low or a high of around 1400, which was around 5 years, I believe. And then we broke out, and I believe that this breakout is as significant as the breakout we saw within 2002, 2003. because of the huge monetary shift that we're seeing with the mass amount of printing. I do think that there's going to be a worry and people are going to think that the dollar is overvalued. I do think that there will be a push up in the dollar before we will start to see it weaken, but it's coming. It might take a little while, but at the end of the day, the amount of money that the government is printing, not just in the United States, but globally, will have an impact in the inflation in the cost of goods and services, because the money now is going to everyday individuals, not just Wall Street. If it was just Wall Street, that money would flow into assets like stocks, real estate, even BTC. But, we are giving it, or the government is, central banks are giving it to everyday individuals who are purchasing goods and services, and the same amount, more money going to the same amount of goods and services will obviously increase the price of those goods and services. So I do think that we will see inflation. We are looking at the CPI numbers around the globe. Econoday is a great source for that. If we go to economic news right here, this is what we're talking about. Econoday, which is the 2020 economic calendar, and then you're looking for consumer price index, which is right here. So then if we click on this, it will give you a bit of an understanding of what it is. Consumer price index is an average measure of the level of prices of goods and services bought for the purpose of consumption by the vast majority of households in the United Kingdom. Month over month, prior 0.4%, consensus 0.0. So they're getting very little to almost no inflation. Year over year, 1.7, consensus 1.5. So they're not really getting any sort of inflation. But over time, we will be able to look at not just the United States, but kind of globally how the inflation is affecting everyday citizens, basically, because that's what really matters, because the confidence of everyday people as a mass will basically either break the dollar down into a point where no one trusts it. Look at the mark, which is the currency of the Weimar Republic in Germany. It's happened before. Look at Venezuela. Look at Zimbabwe. It's happened. It's not like it's an impossible event that will never happen. So that is the completion of the video. Going to take some questions here if there are any. Let's just see if there are any. I don't think so. Is it going up or down? Not sure exactly what you're talking about. Which asset? I'm not sure. So that is the completion of the video. I'm trying to keep them shorter, more broad, kind of macroeconomic shifts, because I do think that is more, not entertaining, but if you kind of grasp the broader understanding of the potential possibilities, I think that's a better opportunity than just talking about charts. And obviously I love charts more than anything in terms of talking about them, understanding them, but yeah, I do think that these provide little snippets of good value. So thank you very much for watching. I think that will be the completion of the global macro update. We will talk about crypto, although this does obviously tie into crypto as well, because I do think crypto will be playing a pretty key role within the next big shift here. More or less blockchain, but also Bitcoin in particular, in my personal view, because we've seen in the past that it is an unbelievable store of value. Yes, it does have huge retracements down of, let's say, 70-80%, but at the end of the day, if you're holding for a very long period of time, there is significant price appreciation that an investor is able to get rewarded with if he or she has the stomach to hold. So I'll cut this video off right now. Thank you for watching, and like always, happy trading.